In this video, we're going to look at some common adjusting entries that we would make at the end of the accounting period. For those not in my class, again, the link to this file can be found down in the description of this video. You can download it in either Word format or in PDF. Alright, so let's look at a few. Now remember, we're in the accounting cycle. There's several steps. In the very first unit in our class, we talked about the analyzing transactions, then we recorded them in a journal, then we posted them to the ledger, and we created an unadjusted trial balance. And we do that throughout the accounting period, and typically accounting period is a year in length. Now you can do it shorter, you can do a month, but we're only going to produce annual financials that are audited and reported fully to the street. Now in that, at the end of the accounting period, we come to step 5. In step 5, we're actually going to record and post adjusting entries. And in the first video, Intro to Adjusting Entries, we talked about why those were needed, the deferrals and the accruals that just happen to be used up over time or accrue over time that we need to update at the end of the accounting period. That's all an adjusting entry is. It's making sure all of our accounts are 100% up to date. And we said the 3 rules. Number 1, it can never use cash. We're not paying cash for anything. We've already received or paid the cash in theory. Now we're just updating the balances of the account. So number 1, never use cash. 2, it has to do 1 revenue and 1 expense. It has to impact the income statement. And 3, it will impact the balance sheet. So it'll either be an asset or a liability. So those are the rules for our adjusting entries. So let's look at a few examples here. There's 7, I think, in total. I've added a little space just so I can write while we're sitting here and chit-chatting as we go along. Below are some additional common adjusting entries. Record the necessary adjusting entries as of December 31st, 2022. For each of the following, assume an annual accounting period that begins on January 1st and ends December 31st. So we're looking at the full year. Remember, companies can follow a calendar year or they can do any fiscal year they desire, and a fiscal year is any 12-month period. For example, governmental agencies, such as the one I work for, operates on a July 1 through June 30th fiscal year. So the end of their year runs through June 30th. Companies can follow calendar or a 12-month fiscal. It's supposed to match your operating cycle. All right. The ABC Pest Control Company purchased equipment for $53,000 on January 1st of 2022. So they bought this equipment on day 1 of this year. Record the first year of depreciation of $10,000. Now, what happens? Well, on January 1st, this is not the answer, but really quick, let's record the journal and talk about it a little bit. We would have bought equipment. So we would have debited our equipment account for the full price, the $53,000 here. That's what went into our equipment. And it doesn't say how we paid for it, so we're going to assume we made a cash payment. Now, again, when you use cash for long-term equipment, that would be an investing activity, just FYI. But that's not the point of this problem. It's adjusting entries, but just a point there to make. Now, we use this asset to generate revenues, and December 31st rolls around. Do we still have the same life that we can use this asset for as we did when we bought it? Well, absolutely not. Think of your car. Every year you use your car, you get 1 year less of life. You've used it for that year in order to produce revenues for you as an individual. So companies do the same thing. We buy that equipment and it will generate revenues for so many years. We don't know how many years in this case, but ever how many years it will generate revenue. We need to allocate this cost, this $53,000, over the periods it generates revenue. Remember, expense recognition. We recognize expenses in the period they generate revenue. Equipment is an expense to us, but we don't want to expense it all up front because it allows us to operate for multiple years. So we're going to take this $50,000 and we're going to spread it across its life. Now, just as a quick example, let's assume that $53,000 and we think at the end of the life we can sell it for $3,000. So what we would do is we'd take $53,000 minus $3,000, and that would give us a $50,000 use. In other words, we're going to consume $50,000 worth of the value of this asset. And then this asset is going to last us for 5 years. So that gives us that $10,000 each year. So in theory, I'm going to use up $10,000 of this asset's value every single year for 5 years to generate revenue for my company. So at the end of the accounting period, we must do an adjusting entry. So here on December 31st, we're going to adjust our books for the amount that we've actually used. Well, how do we do that? Well, a couple of things. Remember that historical cost principle that you've read about? Well, equipment is one of those assets that we will carry at historical cost. So when you depreciate, when you use up this asset's value, you will not hit the equipment account. However, it will become an expense. So when we're dealing with depreciation, we're going to do depreciation expense. Now, the definition of depreciation is simply the allocation of the asset's cost over its useful life. Okay, in other words, the amount we're going to consume. Now, in this case, we're not going to consume 100% of the asset's life. So that's what this salvage value is for. If we don't use 100% of its value, then we want to put a salvage value, and that's how much we think we can sell it for. Its value at the end of its life, at the end of the 5-year period. So as we consume assets, they become expenses. Remember in the last video, supplies became supply expense? Same thing here. It's going to become an expense. Now, how much? Well, we already know $10,000 because in this case, we bought it on January 1st. The annual depreciation is $10,000 per year. Since we held it for a full year, we're going to recognize all $10,000. Now, a lot of people want to hit the equipment account, but be really careful. We cannot. We have to hit an account called accumulated depreciation. Accumulated depreciation is a contra asset account. It is married to the equipment account. So as we reduce the value of this equipment, we will net it with the accumulated depreciation to show the actual book value of the asset. So we're going to hit accumulated depreciation. Just as a note, accumulated depreciation is what we call a contra asset. It will show up on the balance sheet, but it's going to reduce our overall. The word contra means opposite or against. So this is going to go against our assets to reduce the value. So at the end of this year, once we record this $10,000, when we report our financial statements, we would actually show the equipment. So we would show equipment at the full 53. Then we would say less our accumulated depreciation. I'm just going to put AD here because I don't have room for the full name. And we've accumulated $10,000 worth. So we're going to show our net equipment at $43,000. That's known as our book value. So that would give us our net, I'm going to squeeze it in here real small, equipment or net PPE, property, plant, and equipment of $43,000. And again, my apologies, it is a little small. We call that the book value, or sometimes you'll hear it termed the carry value of the asset. The carry value or book value of an asset is the asset itself minus any accumulated depreciation. Okay, so that's the book value. Again, for book, you may see the term carry value as well. Just depends on who you're talking to. So keep that in mind. All right. Now, when we're looking at this, what are we going to record? Well, we've already recorded how is it going to impact our financial statements is what I'm trying to ask there. Well, assets, this is a contra asset. So anytime we increase a contra, we're going to reduce our assets. So remember, no cash, no cash. Do we have an asset account? We do. Accumulated depreciation is an asset account. Even though it's a contra, it's still an asset. It just goes against us. And then offset expense. So we've met our rules. No cash, one expense account, one balance sheet account. Our expenses here are going up because depreciation is an expense. When expenses go up, income goes down. Remember, anytime income is impacted, stockholders' equity is impacted because expenses roll into what we call retained earnings. Retained earnings shows up on our balance sheet. The expense does not. Depreciation expense will not show up on our balance sheet. It shows up on the income statement, but its impact is felt on our balance sheet in the stockholders' equity section. All right, we spent a lot of time on that first one. That's okay. I needed to explain depreciation just a little bit there before we went too far. All right, so on September 1st, 2022, the ABC Pest Control Company paid $24,000 for a 12-month insurance policy in advance. At that time, they debited prepaid insurance for $24,000. All right, so again, remember, we're looking at December 31st here. They bought this insurance policy, find the name for it there, on September 1st. So let's just look at it really quick. I like to analyze the information, make sure we do everything correctly. So on September 1st of this year, 2022, Okay. They went in and they purchased an insurance policy. So what they would do there is they debited prepaid insurance. And my writing's not the best with this tablet, so y'all just have to bear with me. So prepaid insurance for $24,000. Remember, prepaids are assets to us because this will last multiple accounting periods. It's going to go 2022 and last into 2023. So it's at least going to hit 2 accounting periods. So that's the reason we capitalize that cost. We put it as a prepaid. Then as we consume it, we will expense it. And then we paid cash for it. So we would credit cash for 24. All right. So now we get to the end of our accounting period, December 31st. When I'm looking at my accounts, I say, ooh, I've got prepaid insurance of $24,000. Has any of that insurance been consumed? Well, let's be honest. I hope I do not use my insurance. We buy car insurance, but we hope we never have to use it, right? We have house and home insurance, homeowners insurance, but we hope we never use it. But on the off chance that we do, it's there to protect us. But we still consume it. What do I mean by that? Well, when we buy it on September, we have 1 year of policy. But by the time we get to December, have we used some of that? Well, absolutely. We no longer have a year of coverage. Now we only have 8 months left. Okay? So what does that mean? Well, if we only have 8 months left, we must bring this balance down. I cannot report $24,000 when I've consumed part of it. Okay? So I'm going to take that $24,000. I will say, okay, it will bring me benefit, help me generate revenues because it covers my assets for that full year for 12 months. So when I divide that out, I get $2,000 per month. So as time passes, I basically use up $2,000 of this policy because that portion of the policy expires every single month. Now, how much have I used? Well, we bought it on September. It's now December 31st. So that would be all of September, all of October, all of November, and all of December. So I use $2,000 per month for 4 months, or a total of $8,000 of that policy has expired, is no longer valid for me. So since I need to expense that $2,000 a month, I need to expense 4 months worth. What happens? Well, my prepaid insurance is being reduced. So I debited prepaid to create it. So I'm going to credit the prepaid to reduce it. That's what I need to do. I need to take the balance down, right? As we consume these assets, they lose value. And I need to reduce it to, or buy $8,000, not to $8,000, but buy. So what that means is if we were to look at our ledger, and I like T accounts, when in doubt, T it out. That's my motto. And we look at this lovely prepaid insurance account. I'm going to abbreviate there just to make it fit. We started with $24,000. Do we still have 24? Absolutely not. We have now consumed 8,000 of that. Now, what does that tell me? Well, we've used 4 of the 12. So I should still have 8 months left. And if 8 months at 2,000, I should have a balance of 16,000 that will bring me future benefit. Do I? Absolutely. The net of those two is 16. So that's what I'm carrying forward to next accounting period. That will be consumed in 2023. I do not want to recognize the expense this period, only the 8. Now, as we consume assets, they typically become expenses. So this is going to become insurance expense as we consume them. So all prepaids will become expenses. So supplies is an example of a prepaid. Supplies expense. Prepaid rent expense. Prepaid insurance becomes insurance expense. Now let's talk about the impact to our financial statements. Prepaid is an asset to us. Prepaid expenses are assets. So whether it be prepaid insurance, rent, or whatever, all those are prepaid expenses. So our assets are actually going down because we credited the asset. Insurance expenses are going up by 8,000. But what's the rule? As expenses go up, our profits go down. It costs us money. Anytime our profits on our income statement go down, so does our stockholders' equity. There's that direct link. Net income is directly linked to the retained earnings on our balance sheet. That keeps our entry in balance. This little formula here must always balance. Assets equal liabilities plus equity. Statement of cash flow. I forgot to mention that up here. Remember, no cash is involved in adjusting entries. So you should never impact the statement of cash flow when you're doing an adjusting entry. All right. We're already here for 14 minutes. Let's speed up a little bit. The ABC Pest Control Company received $15,600 as cash advance for exterminating services to be performed over a 1-year term beginning October 1st. So we're going to give our clients exterminating services for a full year starting October 1st. At that time, they credited deferred revenue. So I'm a big fan of mentally thinking about this. I don't have to do this, but just so y'all see the point of an adjusting entry, on October 1st, we received cash of $15,600. So that would be a little debit there. Now, did we do anything for that cash? Absolutely not. We owe the services to our customer, so we would have placed it in what we call deferred revenue. So we would have credited deferred revenue for $15,600. So that's our debit and our credit on October 1st. That's already been recorded because remember, the problem says we're at December 31st. We're just looking at our accounts. Now, December 31st has rolled around. Do I still owe my clients a full 12 months of service? Well, no. At this point, I should have provided October, November, and December. So I should have provided 3 months of service to my client. So if that's the case, what I need to do is take our $15,600. That's the total amount that we received from our customers. Now, what period does that last? Well, it lasts us for, I think it was 12 months, 1 year. So we're going to take that 15,600. We're going to divide that by 12. What that's going to give us is our monthly amount for our actual service. So it costs $1,300 per month. Is what we charge our clients. So double check my math there. 15,600, divide that by 12, and you get 13. Now, December 31st, we said 3 months is what we would have earned. So we're going to take 3 times our 1,300, and that should give us 3,900 there. Okay? So that's the amount we have recognized. Now, as we complete the service, deferred revenue becomes revenue. Remember, deferred revenue is a liability account. So over time, it will become, we perform the service, we no longer owe our client, it will become an actual revenue. So notice we credited deferred revenue. We have now earned some of that, so we need to reduce the amount we owe our customers. So we're going to go in and we're going to debit deferred revenue. We're reducing our liability to our clients by $3,900. Deferred revenues become revenue. So we're going to go in and we're going to hit service revenue for $3,900. How does that impact our financial statements? Well, deferred revenue, 1, no cash is involved. Awesome. Deferred revenue is a liability. Our liabilities are going down by $39,000. Service revenue is a revenue. So our revenues are going up. When our revenues go up, the profit of our company goes up. Our net income goes up. When net income goes up, our stockholders' equity is going to follow suit. So that little piece there keeps us in balance. Keep that in mind as you go through. All right, next one. Pest company had salaries of $4,200 earned the last week of December, which will be paid on January 3rd. Now, this happens for a lot of companies, especially those that report bi-weekly. So what happens? Well, let's assume our payday falls on a Friday. So let's just say Monday, Tuesday, Wednesday, Thursday, Friday. Now, here, let's say this is December 31st falls here. So our employees work this entire week. But for the first part of the week, they earned $4,200. But that $4,200 isn't going to be paid until January 3rd. So do I just wait until January 3rd to record it, or do I need to report it in this period? Well, recognition of expenses state you must record the revenue you must record the expense in the period it generated revenues. Now, this $4,200 that we're paying for Monday, Tuesday, that's not going to generate revenue next year. That generated revenue in the current year, okay? So therefore, we must record that. That's an example of an accrual. So when it's salaries at the end of the period, we just do salaries expense for $4,200, and we would credit salaries payable, or it could be wages. This one said salaries, so I'm going to stick with it. We're not paying the wage, we're just simply accruing it. So anytime we accrue salaries, what happens is we have a pay date that falls after the end of the year, but our employees earn the money during the current year. So any days they work this year, whether we pay them yet or not, has to be accrued in the right year. Now, how does that impact us? Well, salaries payable is a liability, so our liabilities are going up by 42. Salaries expense, that means expenses are going up. And when expenses go up, income goes down. It's that reverse relationship there because it costs us money to generate. So your profits of your company go down when you have to pay expenses. Anytime income goes down, so does our stockholders' equity. I'm just trying to make that point there that income and stockholders' equity are related. You will not see an expense account on a balance sheet, but expenses and revenues roll into retained earnings, and you will see retained earnings on the balance sheet. And that's why it impacts stockholders' equity. Again, no cash flow because in adjusting, you should never have cash involved, so it will not impact the cash flow statement. All right, just a few more here. We got 3 more on the next page. ABC Pest Company borrowed $50,000 on July 1st by signing an 8% one-year note. Principal, I can't talk today, and interest are due on June 30th of 2023 or next year. All right, so again, July 1st, we borrowed some money. So just for the fun of it, let me record the July 1st down here just so you see it. When you borrow money, you would have received cash because you borrowed it for $50,000. And then we signed a note. So we're going to record a note payable. We owe the bank money here for $50,000. Now, this is another example of an accrual. This note will sit there at $50,000 until June when we pay it back. But the problem with that is every day that passes, you're going to accrue interest. On July 2nd, you owe 1 day of interest, July 3rd, so forth and so on. In accounting, we're going to record that as an adjusting entry at some point throughout the calendar or fiscal or calendar year. So on December 31st, I'm going to record all of my interest. Well, how much interest would accrue? Now, this is very important for your personal life. This goes beyond just accounting because you can use this on your own loans to find your balances. So what you do is you take your principal, the amount you owe today, times the rate of the note times time. I call that PERT, P-R-T, principal times rate times time. Rates on notes are always expressed in annual terms or 12 months. In other words, your credit card, it says 16%. That's per year, not per month. So you divide that out and it would be 1.something% per month that you pay. All notes are that way. You only pay the rate is if you hold the note for a full year. So the principal of this note here, we're going to take $50,000. That's the amount we owe at this point in time, times our rate. Our rate is 8%. So we're going to go in and do times 0.08 or 8% times time. Now that 8% is per 12-month period. Did we hold it for 12 months? Not yet. A lot of people say, yeah, it's 1 year note. We're going to hold it 12 months. But we haven't accrued that yet. We only need to accrue July 1st through December 31st. So we need to accrue all of July, August, September, October, November, and December. So we only need to accrue half of the interest on this note. Okay, or 1/2 or 6/12. That's half a year or 4%. All right, so what I want you to do is if you don't have a calculator out, you always need a calculator when you're dealing with accounting. So pull out your calculator. You're going to multiply this out. You're going to take your $50,000. You're going to multiply it by 0.08 or 8%. That's the amount we signed the note for. That's an annual interest rate. And then you're going to times it by 6 divided by 12 or simply divide it in half because that is half. And I get that we owe $2,000 in interest at this point in time. Again, that is an example of an accrual, okay, because interest accrues over time. Now, how are we going to record that? Well, one, interest on a borrowed note would be interest expense. If you were the lender, it would be interest revenue. But to us, since we borrowed the funds, it's definitely an expense. So we're going to go in and hit interest expense for $2,000. This also increases the amount we owe. We do not want to hit the notes payable though, because the note needs to remain at the principal balance. Otherwise, they'd charge you interest on top of interest, and you don't want that. You don't want compounding interest. You want simple interest. So we're going to hit interest payable, not the note payable. The note remains $50,000, but the amount of interest we owe on that note increases, and that's going to be the $2,000 as well. All right. So PRT, can you use that? You can. That's actually one of those wonderful accounting things that's universal. You can use it in your personal life. So Highly recommend you do that. You can see how much interest you're going to have to pay on your mortgage each time, or your car note, or whatever you have, by taking today's balance on your payment date times ever how many days between your payments interest accrues times whatever rate you're paying. So that'll tell you how much interest. All right, moving on. How does this impact us? Well, our liabilities are going up by 2. Notice liabilities, we have to impact assets or liabilities. And then the income statement, expenses. Expenses go up 2. That makes our income go down. Anytime expenses go up, income goes down. Anytime income goes down, so does stockholders' equity. So that's that relationship there. We're still in balance. Again, no cash flow. Number 6, ABC Pest Control Company purchased machinery on July 1st for $36. The annual depreciation on the equipment is $6. Here we are at depreciation again. So we know it's depreciation expense. We've already done one of these just a moment ago. So we know we're going to hit depreciation expense, and we're going to hit accumulated depreciation, and it's going to blow up. Let me fix my formatting real quick. There we go. How much? Well, here, why do we have another example of this? I wanted to just show you that's an annual depreciation amount. We will depreciate based on the length of time. Since we purchased this on July 1st, we would only need to depreciate half of a year's depreciation. So we'd take that $6,000, times it by 6/12. Why 6/12? Well, July 1st through December 31st is 6 months that we used the actual asset. So that's going to give us, let's see, $3,000 in total, or half of the balance. So just be really careful. If you do not hold an asset for a full year, we do have to prorate it. Now, the rule of thumb typically is whole month or no month. Typically speaking, you're not going to see day count and depreciation because it's an estimate. So what you're going to do is you're either going to depreciate the entire month. So say we bought it on July 10th, we would still do all of July. If we bought it on July 25th, we would not count July and just start in August. So whole month or no month is typically the way we will handle that. I have never seen day count depreciation in my life, so I don't think it exists. But, it could, because I haven't been in every company in the country, so go with it. All right, so $3,000, just like before. How does this impact us? Well, accumulated depreciation is a contra asset, so anytime we hit that account, it's going to take our assets down. Depreciation expense is an expense to us. Our expenses are going up. When our expenses go up, our income goes down. But don't forget, when income goes down, so does your balance sheet over here. Your stockholders' equity goes down. That keeps us in balance there. All right. Last one. This is another example of an accrual. This is a deferral. You bought this equipment, machinery on day 1 here. You defer the expense until the end of the period when you've actually used the asset to generate revenue. Here, we lent $10,000 and received a 1-year 6% note. It should be note. My apologies there. Note on May 1st, 2022. Principal and interest are due on April 20th, 2023. So again, here we we loaned money, lent money to someone. Don't know who, but we did do a loan here. Now, when we make a loan, what do we record? Well, this is going to be a little different on May 1st. We would have actually recorded a notes receivable because someone owes us money now. In the last problem, it was a notes payable because we owed them. They owe us in this. So we're going to hit our notes receivable for $10,000. And then we're going to credit cash because our cash goes down when we lend it to someone else. Now, December 31st rolls around. Do we have to do anything? Well, this is an example of accrual. What's going to happen over time is interest will accrue on this note. So just like before, we're going to use our faithful friend PERT. You want to remember PERT always. You'll use it extensively. I use it in my personal life all the time. So 10,000 times rate of 6% or 0.06 times time. This is a 1-year note. Although we have not held it for a full year, we signed it on May 1st. So we're going to count all of May, June, July, August, September, October, November, and December. So we've held this note for 8 out of a possible 12. Now the 12 is not because it's a 1-year note. The 12 is because interest is always an annual rate. Okay. This could be a 12-year note and we would still use 8/12. Okay. Do not consider this when you're talking about this. This only tells us when it matures. Interest is always an annual rate. You pay 6% per year, per 12-month period. So this could be a 20-year note. you pay 6% per year. So you'd still do 8/12 no matter how long, no matter the duration of the note. All right. Now, when we multiply that out, what do y'all end up with? So again, make sure you've got your calculators out. You're going to take your actual $10,000 in principal. You're going to multiply that. So hit your little multiplication button, times 6% or 0.06 times our 8 divided by 12. What do y'all end up with? I got 400. I hope that's right. If not, y'all yell at me in the comments and I'll update that. Well, no, I won't. I'll just make a comment and tell y'all it's wrong. Double check ourselves. So 10,000 again times our 6% times 8 out of a possible 12, and it gives us 400. All right. Now, how do we record this? Now, be careful here. We are lending money, so we wouldn't have an expense on us. We're actually going to receive more than we lent at the end of this. So that's actually a revenue. So we're going to hit interest revenue instead of interest expense. Now, it doesn't add to our payable because this is a receivable. You don't want to hit notes receivable. You're going to hit interest receivable to record that in a separate account. You don't want to touch the principal balance for the interest. All right, how does that impact us? Well, our assets are going up by 400. Interest revenue is a revenue, so our revenues go up. When our revenues go up, our income increases as well, y'all. As income increases, so does stockholders' equity. Statement of cash flow should not be impacted at all because these are adjusting entries and they shouldn't involve cash. All right. So that is an example of some common adjusting entries. Again, for those not in the class, the handout is in the description. On the next video, what we're going to do is we'll do some adjusting entries and then we're going to take you through the rest of the accounting cycle. We're going to record some adjusting entries. Then we're going to actually produce an adjusted trial balance, prepare our financials, and close our books. And that's sort of the end of the accounting cycle. We'll do that in the next video. Y'all have a wonderful day.